Mortgage rates remained around 7%. Housing inventory is still falling and we're still below 500,000 homes for sale in the entire country. New construction remains king as they hold most of the available supply and can offer huge incentives and low rates. And as you're going to see, home builders across the board have been raising their home prices every single week, and it's only February. And for the first time in years, we're starting to see some real hope in the new listings data. We're covering all this and more in today's weekly market update. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I give you a weekly market update covering all of Dallas and Collin counties. We're looking at trends, we're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, and what's inventory looking like. And if you stick around until the end, it's my favorite, the top 10 ranked charts of the hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to move in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, it's February 12th. Let's see what the data is telling us. And if this is an old video, you can click the playlist here to get to the latest weekly market update. First up is market news. This week, we're going to be covering why all of those social media accounts screaming for a housing bubble crash have been wrong. And they've been doing this for the last decade. U.S. housing credit looks nothing like it did in 2005 to 2008, and homeowners have literally never looked better, as we're about to see. In fact, the main people we need to be concerned about are not homeowners, but renters. If you own a home, your payment is fixed for the next 30 years, and you've probably got a ton of equity already. These younger renter households, or those with lower credit scores, those are the ones really showing credit stress today. Here is one very important concept you all need to understand about home ownership. After the dust settled from the 2008 crash, we got new mortgage laws in 2010, and from then on, this has been the case. Since 2010, everyone has been getting 30-year mortgages, and their wages have been rising every year ever since, meaning their cash flow versus the cost of their mortgage every month has been getting better every single year. Add to that 3 refinancing opportunities in 2012, 2016, and 2020, so their monthly payment has gone way down from where they started by refinancing. At the same time, their cash flow has gone way up from wage growth. And on top of that, their homes are now worth 2 to 3 times what they were when they purchased them. So they have a ton of equity. This is not a recipe for a housing crash. As I mentioned, after 2010, the qualified mortgage laws came into play, and all those insane high-risk loans that everybody was taking from 2002 to 2005 completely disappeared. They don't even exist anymore. Back then, you could literally walk into a bank and get a mortgage based on stated income, meaning you could just walk in and tell them, I make $200,000, and they would take your word for it and give you a mortgage. Not only that, but as you know, a lot of these loans were on adjustable rates, meaning 3 to 5 years down the road, your monthly payment could adjust and be way higher. And of course, as we now know, that's exactly what happened. These loans were literally time bombs, but these loans don't exist anymore, which means housing should only show financial stress when people lose their jobs and can't pay their mortgages. Whereas the 2008 crash simply happened because all of these loans were time bombs and their time expired. So the biggest component of that crash doesn't exist. But let's look at the chart of foreclosures and bankruptcies. Look back here, even at 2001, how high the rate of foreclosures and bankruptcies was compared to today. Look at that huge difference. So this would have been considered a normal market, and look at us now. Back then, the number of foreclosures, about 200,000, was totally normal. But more importantly than that, look at this big run up of foreclosures and bankruptcies from 2005 leading up to the crash in 2008. This is all a huge sign that there is financial credit stress in the market. Again, this exact same chart looking at today. Where is the credit stress? It's not existing. This is the healthiest it's ever been. Extremely low foreclosures and bankruptcies, no time bomb loans to worry about. Just look at the contrast of these two markets, even back in 2001. Look how normal it was to have 200,000 foreclosures. Look where we are now. Look where we've even been before that. And remember, 2010, we got new lending standards, and what's happened ever since then? Things have gotten healthier and healthier in the credit market. And to further prove this point, look at this next chart, mortgage originations by credit score. What this chart shows you is people buying homes are the most financially responsible generation yet. We have had an explosion of people buying households with a credit score of 760 plus. This is the blue lines here. But in fact, this has actually been going on since we talked about in 2010. It just looks much bigger here because we had a huge explosion of people refinancing. This includes refinances. That's why in 2020, that's why it looks so much bigger. But the reality is we have been in a much healthier credit position ever since 2010. And what you need to know is the median credit score for newly originated mortgages is 770. 770 is the median credit score for people getting mortgages. Now you compare that to way back here in 03, 04, 05. Look at what the credit scores were back then. This looked nothing like this. This is nowhere near this. This is much healthier. So obviously the credit market when it comes to housing is just much healthier. So what happens when the next job loss recession does hit? Well, we're already working from near record lows in the credit delinquency data, and all these homeowners have a ton of equity and are in great financial shape, which is nothing like we saw in 2008. In fact, over 40% of homes in America don't even have a mortgage on them. And everyone who bought after 2010 has a ton of equity and would be able to sell their home long before they had to enter a foreclosure. But remember, the foreclosure process can take 9 to 18 months from start to finish. Many people are going to be able to find employment before that time period is up and stop the foreclosure. In 2008, we had 4 years of credit stress building up in the system that finally exploded when all of these bad loans, their adjustable rate, hit a higher rate, everybody's monthly payment went too high, the whole system exploded. Today, we have none of that. We have no credit stress, we have the most qualified, financially responsible buyers ever, and no time bomb of high-risk mortgages. Which brings us to our last chart. Total balance by delinquency status. In a normal market, you can see that around here and you can see that back here. Around 5% of homes are delinquent and about 2% of them are in severely derogatory status. That is this blue color. Now you look at today. We're still at about half of that with much closer to a 2% total delinquency status and only 1.1% being severely derogatory. So we could double these numbers from here, and that would only just get us to a normal market. This is not housing crash territory. So in summary, all those accounts are wrong. They have been for over a decade. Let's move on. Starting with national housing inventory, this week we had a decrease again of 2,527 homes for sale in the US. Historically speaking, we should see the bottom of inventory around January or early February. However, since COVID, the bottom of inventory started in March and has only been getting later every year, all the way until last year. It didn't happen until April 14th. So our hope is that inventory will bottom out soon rather than in March or April, because we want to just get closer and closer to being back to a normal market. Now let's look at the new listings data, and this is the best news we've received all year. This is the first report we've seen that actually gives us some hope. As you can see on this chart, after just pacing at or slightly above the previous 2 years of new listings, this week we finally had a huge spike of new listings. And this is our first sign of hope, because if this continues, we could have new listings every week that are going to blow the last 2 years out of the water. We're going to have a lot more houses. It's going to get a lot healthier for home buyers and home sellers, because everyone who sells also has to go and find their next home. We just need more homes on the market. As I mentioned, there are less than 500,000 in the entire country, a country of over 330 million people. So this is our first sign of hope. We really want to see this continue. We want to see tons of people listing their homes every week. And just trust me, this is exciting. The next thing we cover nationally is the number of homes having price decreases. And looking at the national chart, this week we're at 30.1% of homes having a price decrease, down from 32.2% this time last year. And this was the biggest leading indicator all of last year that there was not going to be a housing crash. If you're going to have a price crash, you would start by seeing the number of homes having price decreases every week going up, not going down like they have been all year. And we're going to look at all of these numbers in our local markets here in a minute. Okay, now we're moving on to mortgage rates. Mortgage rates last week started at a 7.04, got as low as a 6.95, and ended at a 6.98. So another nice boring week. We did have a 0.06% change for the week, but this is the kind of boring, stable rates that we need, because as we always talk about, stability brings confidence for both buyers and sellers. If you want to buy or sell a home, you need to know that rates are not going to change 1% over a weekend. So yes, they're higher than you'd probably like them to be, but they're stable, which means you can make an informed decision. The last thing we're looking at here is the 10-year. As you can see, it has been trying really, really hard to break out of this range, and my prediction range top for the year was around a 4.25%, which at the time would have corresponded with about a 7.25% rates, but good news is the spreads have been improving. So even if we got here to the top of this green line, I don't think mortgage rates would get as high as 7.25, because even right here, they've only been getting as high as 7%, and actually it was like 6.9 last week. So I really don't think rates are going to go up much, and all that we really need is for any sign of the jobs market getting weaker, and we're going to see lower rates. But as you can see today, it's trying to push up again. but so far has been unsuccessful, so it looks like 7% is the top for now. You sure would hope to see a Monday that's going down, but that does not seem to be the case this week. Now regarding mortgage purchase applications, this week we actually saw a 1% decrease in the number of people applying for mortgages. So after 8 straight weeks of positive growth, the last 2 weeks have been negative. Though looking at mortgage rates, it's obvious why. Mortgage rates down near 6.6%, a ton of new people are coming in, back up near 7%, less people are coming in. Okay, before we move on to the local markets, if you're considering buying a home in 2024, 2 things. First, I'm now doing a weekly home buying webinar. This is for anyone who may be considering buying a home in the Dallas-Fort Worth market in 2024. If that's you, click the link below and sign up. And there's also an option where you can watch a replay if you'd like. And number 2, I've developed a max affordability calculator that many of you have already used. This will help you very quickly and easily get into the ballpark of what price home you should actually be looking for based on your personal financial situation and today's rates. It will give you several different options to review, and it takes into account everything all the way down to your income tax bracket. This is completely free, so take advantage of it, and if you want to learn more about it, there's a walkthrough video here that you can watch next. Okay, now let's move on. We're starting with the MLS data, starting with Dallas County. We had 518 new listings in the last week. That's 40 more than last week. 219 closed sales, 37 less than last week. 310 went under contract, 12 less than last week. Of the homes that closed, 59 were immediate sales, meaning they contracted within the first week, 4 more than last week. In total, there are 1,942 homes either under contract or in pending status. That's 26 less than last week. Moving on to Collin County, we had 302 new listings. That's 11 less than last week. 138 closings. That's 88 less than last week. 178 went under contract. That's 9 less than last week. Of the homes that sold, 33 were immediate sales. That's 1 less than last week. And in total, there are 1,733 homes either under contract or in pending status. That's 115 more than last week. Okay, moving on to local housing data. If you see my videos, you know I use the Market Action Index. It just takes into account all of these factors, puts it into one nice, easy to read graphic with a number. Dallas County is still at a 43, only a slight seller's advantage. You can see it's heated up since last month. That's this gray bar was last month. Nothing too exciting here. The reason we reference this is basically just to see, are things looking normal or are things looking weird? And so far things are looking normal. What we see in Dallas County is median list prices starting to go up. That's normal for this time of year. Basically from now through the summer, we expect prices to increase. We expect days on market to come down, which we have here, down from 56 to 49. Number of homes having price decreases should either hold or drop. For now, it's holding. Inventory, this is good news for Dallas, where the rest of the country is kind of still dropping. Dallas has been pretty flat. That's good because then when inventory starts to grow, as more people start to list, we're starting from a higher bar than other places will be. And then of course, the Market Action Index, which is just telling you how hot is the market. This is going to increase as time goes on, again, through the summer market. So everything here just looks exactly normal. That's what we're looking at here. Okay, moving on to Collin County, similar story. Median list price has been climbing. Price of new listings climbed a little early, but is kind of holding steady now. Median days on market as well, just holding at 42. The big number I've been talking about in Collin County here is you've got to look at the number of homes having price increases. This is because there's a lot of new construction in Collin County. These are the home builders. The home builders get all of the data that I wish I had in real time because they can see exactly how many people are walking into their model homes, getting approved with their lenders, contracting on their lots. That's all data that I'll never see. Whatever they're seeing in real time is leading them to believe it's time to start increasing prices. And this is literally 8.41% of homes on the market in Collin County had a price increase this week. And just to show you some reference, this dot, each one of these dots is a year. So 1 year ago, only 2.92% of homes were having price increases. The year before, only 4.59. So compared to the last 2 years, this is significant. 8.41% of homes had a price increase, where last year was only 2.92. This is important. I don't know how else to say it. Home builders are seeing the data that I can't see yet, and they're seeing that there's enough demand to raise prices. And they're doing it. 8.41% just this week and climbing still. Okay, moving on to my favorite part. This is the top 10 ranked charts, hottest and coolest cities and zip codes in all of Dallas and Collin County. This is using that same Market Action Index, and that Market Action Index number, anything a 30 or below is a buyer's market. Anything above a 30, we're just asking how hot is the market. So starting out with the hottest cities list, Coppell remains the #1 spot, followed by Louisville, Plano, and Carrollton. They all held their spots. Then Grapevine heats up 1, Richardson heats up 1, Saxe heats up 2, Allen remains, Duncanville cools off 4, and Garland remains as well. So those are the top 10 hottest cities. And again, a 30 or below is a buyer's market. So when you're up at 55, that is a very hot market. Now we like to zoom into specific zip codes. The absolute hottest is Plano, 75023, followed by by Garland 75042, Dallas 75287, Louisville 75077, Plano 75025, Louisville 75067, Frisco 75035, Carrollton 75010, Plano 75024, and Carrollton 75006. Those are the top 10 hottest zip codes in all of Dallas and Collin County. Now we're moving on. We're doing the exact same thing in the coolest markets. The absolute coolest market is Van Alstyne, followed by Leonard. Those remain, and they're the two buyers markets in all of Dallas and Collin County because they're below a 30. White Wright remains at number 3. Seagoville cools off 1. Balch Springs heats up 1. Nevada remains. Rockwall cools off 1. Farmersville cools off 1. Red Oak jumps onto the list at number 9, and Rowlett jumps onto the list at number 10. And the big news is that Ferris heated up from the number 7 coolest city completely off the list. Now zooming into zip codes, the absolute coolest, Van Alstyne 75495, Leonard 75452, Dallas 75223, White Wright 75491, Dallas 75204, Seagoville 75159, Dallas 75203, Balch Springs 75180, Dallas 75253, and Nevada 75173. Remember, if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. Call, text, or shoot me an email. All that is in the description below. Thank you for watching, and I'll see you in the next video.